Hi, I'm Mark Yegi, and I put together a video for you talking about the sacred rules of trading. This is by no means a full list of all the rules that I use in my trading of my hedge fund, but it's a pretty good start, and I explain a lot of the things in there. You'll want to stick through to the end, because at the end I offer you a couple of free resources that you can use in your own trading. Hope you enjoy.
Welcome to Sacred Rules of Trading. I'm a hedge fund manager, and I've been trading for over 40 years, and I've done lots of research and researched other researchers like William O'Neill and other traders like Jesse Livermore, Nicholas Darvas, Ray Dalio, Paul Tudor Jones, and Warren Buffett. And what I've noticed in doing all that research, and in addition to my own trading, is that there's a lot of things that these people do that are pretty similar. And so let's talk about that today. The sacred rules of trading. The first rule is buy higher highs and sell lower lows. You've all heard this if you've been trading at all, and this is a trend type of a trade. The thing is, a lot of people say, well, the stock is at 52-week high, so it's probably topping out. I can't really afford to buy it here. But have you ever seen a 52-week high that goes even higher? So for example, a stock goes to 50, and that's the 52-week high. Well, you don't want to buy it there. It's too expensive, in quotes, right? But if you don't buy it there and it goes to 60, now it's at a 52-week high. Are you going to buy it there? When do you buy it? You should probably buy it at a 52-week high, or some kind of weekly high, whatever the time frame is for you. Because what most people try to do is they think it's like going to the mall. And they think, wow, that jacket is $180, but it's on sale for $140. Well, that's not how the stock market works, because if something's on sale for $140, it's probably going to go lower. It might even go to $100. And so you don't know where the bottom is. You don't know where the top is either. But when there's a trend and volume supporting that trend at the tops, stocks tend to go higher. And when there's trends that are going down and there's volume supporting those trends that are going down, they tend to go lower. So buy higher highs and sell lower lows. One quick note is that Warren Buffett doesn't do this. But Warren Buffett has the ability to sit on things for years and years and years. So what he does is he identifies great companies, which is what most great traders do, is they find a great company, and then tries to buy them at a really great valuation. And he has lots of people that are looking at the valuations. If they're discounted and out of favor, boy, he loves that, because he can sit on it for 3 or 4 or 5 years. As a trader, as a shorter term investor, sometimes we don't have the ability to withstand the down, because we can't, again, pick the exact bottom. And so we can't withstand that if we want to have it go back up. Sometimes it goes down again and again and again, and sometimes we have to trade it, sell it out, and take our loss. Warren Buffett doesn't always have to do that. Sure, he takes losses, but he doesn't always have to. Let me show you what I mean. If you look at Netflix, and you wanted to buy Netflix late in 2017, you would see that the high of it is right around $204. And if you didn't have the ability to foresee this, like we never do, you would have thought, well, that's a pretty high price. It's come here from, 150 and it's come up 25, 30%. And you wouldn't have bought it. And if you didn't buy it, then you would have missed out on all of this, because what happens is it makes higher highs constantly. Then it has a correction, and then it goes back into making higher highs. So these higher highs are annotated by swing points: 286, 333, 338, 423. Now, if you didn't want to buy this high down here at 201, you would have missed a double in just 6 or 7 months in Netflix. And then look, it starts to create lower lows. You've got a gap down on volume. You've got a gap down again. You've got lack of trending here, so you probably want to get out of this. But you can see that there's some trending, and if you want to be on that trend, you can capitalize on it. So this trend went from 423 down to around 250. And if you were the kind of person that says, well, I'm going to get greedy and I'm going to keep going because it's 423. Well, there's some signals in here that are telling you that the markets are coming down and you need to heed them. Now, let's look at what happened in Netflix. After it came down to that 250 that we just showed you on the last chart, it went back up and then it continued to go down, and it finally made a bottom. And once it made the bottom along with the market here, you see a huge recovery. And look what it did. Higher highs every single day practically, until it got to 358. Then a little bit of a correction, and then higher highs again. So the point here is trade it when it's going to higher highs. If you look at it on a weekly, you can really see it. Higher highs all the way up Some spots where it's having pullbacks that are, just typical normal pullbacks, but higher highs and then here, lower lows is certainly what you can see. Yes, I know it's hindsight, but when you look at things in hindsight, you can start to understand what you should have done. And this is a pattern that repeats over and over and over again. All right. Great traders would rather be rich than right. The point is, we're going to be wrong on most of our trades. And say, in fact, I'd probably say it's going to be at least half of your trades you're going to be wrong. Look, when you buy a stock, there's a seller on the other side of that stock that thinks he's right too. And so you have a 50-50 chance of being right the moment that you buy the stock. So get all the odds stacked in your favor, even though it's really 50-50. If you can get some trends in your favor, if you can get some chart patterns, some volume patterns, things that can move that from 50 to 51, 52 to 60%, you're not going to get them all right. But you're going to give yourself a slight edge. And if you have a system that has a slight edge, which you know either through experience, back testing, or both, that you could stick to that system, then it's going to work for you over the long term. But you'd rather be rich than right. So if you're going to be wrong small, be wrong early, and if you're going to be right, you're going to go ahead and try to stay right as long as you possibly can. We'll talk about that in a couple minutes with some other rules. But you'd rather be rich than right. Ignore the experts. Look, you could turn on CNBC any trading day and you can see two traders that both will argue about which way the stock is going. Well, that's what makes a market. There's a show called Fast Money on CNBC where you've got 4 or 5 traders sitting there arguing with each other. They're all experts, but one of them will say the stock is going down and it's a great short, and the other one says it's going up and it's a great buy and you should buy it right now. Who's right? Well, either both of them are right or neither of them are right, or only one's going to end up being right. But who cares if it's right or wrong? You just want it to make you money. Those experts don't know any more than you are probably, and if you listen to them, it's just going to confuse you. So ignore the experts. In late 2018, the experts were all saying that interest rates are going to go sky high in 2019. In fact, there'd probably be 2 to 3 interest rate hikes. Well, now they're talking about, here I am in 2019, that there are going to be interest rate drops potentially. There's a 50 chance of being having an interest rate drop. So if you listen to the experts about how there's a recession in 2019, or they know this or they know that, you're going to be led astray, and it's going to just lead to confusion. Shut off the TV, ignore the experts, do your research, rely on your system, and you're going to make money. Before you make the trade, have a plan. Know your entry, your exit, and your target, and then what if scenarios. What if the stock goes here? What will I do? What if the stock goes down there? What will I do? And write it down so that you can't change it. What happens is, in the moment, during the trading day, emotions will get the best of you. And you're going to talk yourself into different things if you don't have a written trading plan that you always stick to. So before the trade, not during the trade, have a plan, an entry, an exit, a target, and then contingencies. What happens if it goes here? What happens if it goes there? What am I going to do? Study the patterns in the charts. That's what great traders do. They study the patterns. And the patterns repeat over and over and over again. We've got research going back for 120, 130 years now. And those patterns just keep repeating on the great stocks. And if they keep repeating, why wouldn't we want to continue to believe that they're going to repeat? This is not different. This is human emotion. That's what a chart is. It tells you what the human beings are emotionally doing. Whether the stock's going up, you'll see a trend. If it's going down, you'll see a trend. All those trends are put in the charts. And when you do price volume analysis like we do, then you can start to see the volume is supporting the price movement. So study the patterns in those charts. And the more charts you study, the better your eye will get at picking out those winning patterns over time. Be patient with your winning trades and impatient with your losing trades. You know, there's fear and there's greed. And in the markets, you have to treat them the opposite way that you would normally treat them. When you are starting to make money, don't let the fear of losing a profit kick in and sell. That's when you should be pressing your bets within your risk management parameters and within reason. But when you're starting to lose, most people think, oh, I'll just average down. Never do that. Never think you're smarter than the market. So be very impatient with that losing trade and get out as soon as possible. But be very patient with those winning trades. Sometimes you could work your way into a trade that you can hold for a long, long time, maybe months or even years, because you're now in such a big cushion that you can't lose money even if it's going into numbers. So be patient with those winning trades. Sell on strength but not the opposite. What do we mean by that? Well, great traders realize that there's euphoria and emotion in the markets. And when there's a time for them to sell on strength, because everybody's piling in and it may be a long run into the stock, they realize that that's probably the best time to get out because other people might be getting out as well. So they sell on strength. But you know what? When there's weakness, they're not buying, because weakness shows that the stock tends to not support those levels. And so you don't want to buy on weakness. You always want to get into something on strength, but you want to sell on strength as well. So just know that you don't want to wait till something drops and nobody wants it anymore. Sell it when everybody's buying it. Buying it sometimes when everybody's selling it, as long as there's a trade or a pattern that's in place. They are comfortable with being uncomfortable. They're comfortable with discomfort. Look, we don't know if a stock's going to go up or a stock's going to go down. We don't know if a stock's going to go in our direction. What we can do is we play probabilities. And that's discomfort. That's uncomfortable for us to feel probabilities because there's not a lot of certainty. And if you can get comfortable with living in uncertainty about the market, you're going to trade much better because you're going to be taking out the emotion. When you actually have your trades in the market, money in the market, as opposed to being in a paper trading situation, that's when your emotions start to well up. If you can handle those emotions, be uncomfortable with that uncertainty, you're going to be a better trader, and that's what the great traders do. Do not strive for perfection. You're never going to pick the top. You're never going to pick the bottom. Just try to pick that bell curve, that 80% in the middle. Those two standard deviations on either side of the middle. Try to get in there and get the stock and get out of the stock. Not when it's at its high, not when it's low, but when it's statistically moved enough for you to do that. Perfection is the enemy of good. So let's not strive for perfection. You're not going to get perfect trades every time. So why even try? React and anticipate rather than predict. You know, so many people ask me, hey, what do you think about the market? What do you think the market's going to do this year? You know what? I don't know any better than you do. If you flip a coin, you have just as good a chance of being right as I do. Now, I believe in some macroeconomic factors like lower taxes, less regulation, and the Fed. All those things play into the longer term trends. But can I tell you what the market's going to do this month, this year, next year? I really can't. So I let the market tell me what it's going to do, and I react to the market. I try to anticipate what I think it's going to do, but you know what? Like we said before, I can be wrong too, and I'm wrong a lot. And so why would I want to try to be right in the direction of the market? And the market dictates 70% of the direction of a stock. So if the market's telling me that something's going down, I want to listen and I want to get out. So I don't want to predict it, I want to react. And that's what the great traders do. Never, ever, ever add to a losing trade. That's what we talked about before. Just because something seems like it's a good deal or it's on sale doesn't mean you need to buy it. Just because something's going down doesn't mean that it's not going to continue to go down. And most people, what they do is the stock goes from 120 down to 100, and they think they get a 20% discount. Well, the stock goes now down to 80, and that's another 20%. If you just waited till it got to 80 and had some signs of reversing, that's the time to buy it. But not trying to scoop the bottom because there's a value play or a sell. You're not going to be able to do that. But most people will buy a stock at 120, it goes to 100, they buy more because they love it even more now because it's even cheaper. Then it goes to 80. Pretty soon you've got all your eggs in that basket, and if it goes to 60 or 50, I mean, now you're down more than 50% on the investment, at least on your first one. And when that happens, it's very, very difficult to recover. And it takes a long time to recover, but usually a pretty short time to get into trouble. So don't add to a losing trade. If you're wrong, just be wrong small and move on to the next trade. There's always another trade around the corner. A consistent mindset will allow you to stay in your system. See, if you have a system that you believe in, that works, that's been tried and true and tested over time and tested with your experience, there's no reason to go changing your system because the market changes. I know there are people out there that say, well, the market's shifting, so I need to go into a value mode and buy things on sale. Or the market's trending and I need to become a trend trader instead of a value trader. Whatever the system is for you, stick with it because you've believed in it. And that's going to keep the emotions out of it. If you keep changing your systems, you're never going to have anything consistent in your trading, and you're not going to know what works and what doesn't work because you're constantly trading based on the markets and your emotion. So stay with your system and keep that consistent mindset as unemotional as you possibly can. Great traders and the people that I know, including me, hate the color red. Now, what do I mean by that? It means that when something turns green right after you buy it, that's your favorite trade, because that's the time you feel like you're right. Not that being right's important, but you've made the right decision, you've calculated, and you've gotten into the trade at a really good spot with higher probabilities of being correct over time. But when they go against you, and at least half of them will, you need to get out. You just got to get that red off your screen, because the red does a lot of things to you psychologically. It can paralyze you. It can make you feel like, well, let me go ahead and average down. It makes you do all these crazy things. Get it off the screen. Hold a portfolio that shows green trades. There is nothing better than that feeling of opening your computer in the morning, pulling up your portfolio, and seeing everything you own is green, or almost everything. There's very little red on the screen. Get rid of it. Get it off the screen. Move on to the next trade and try to get a green one. If you're wrong 3 times, that fourth one being right is going to make up for those 3 times if you're doing the right risk management. And so that's the goal, is to get those trades that are green. Be wrong really small, but be right really big, and be patient with those green trades as they continue to go in your favor.
So it's the end of the presentation, but not the end of the learning. You see, I've spent 40 years trading, and I've made a lot of money, and I've lost a lot of money too. And that caused me to learn a lot, and I want to share that learning with you. So I've developed a checklist that I use in my hedge fund, and I'm giving it to you for free. It goes through the major points that you should look for before you buy a stock, like earnings per share, like sales, market direction, return on equity, and 12 other items. It'll help you make money. It'll keep you from losing money, which to me is like the most important thing that you can do in the market, is prevent losses. So click on the link below to get my free stock trading checklist. And if you're watching this on YouTube, be sure to subscribe so you can get stock picks, market analysis, and other ideas before they hit the market. Thanks for watching.